Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Nvidia and AMD agreed to pay 15% of China AI chip revenues to the U.S. government in a deal for export licenses. The unusual arrangement could unnerve both American companies and Beijing. How big a hit is this for chip makers' bottom lines? We asked Wang from Constellation Research, which holds and tracks Nvidia closely. Meanwhile, the India-US tariff tensions risk deepening a $6.3 trillion gap between Chinese and Indian stocks. The benchmark MSCI index now on track for its biggest annual underperformance since 2017. So should investors look to China or India for gains? We'll ask Bank of Singapore's global CIO, Chia, and get insights from Bajaj Finserv's Group President for Investments, Lakshmi, Iyer, and Pakistan's Minister of State for Finance, Bilal Azhar Kayani, joining us exclusively as his country secures a lower U.S. tariff rate than its South Asian neighbors, including India. Our top story, Nvidia and AMD will pay 15% of revenue from Chinese AI chip sales to the U.S. government under a deal to secure export licenses. A source tells Bloomberg that Nvidia's H20 and AMD's MI308 chips are covered by the arrangement. The deal reflects President Trump's ongoing push to extract financial returns from trade concessions. But the unusual arrangement risks unnerving both U.S. companies and Beijing, which is seen unlikely to warm to the idea of a chip tax. China has also grown increasingly hostile to the idea of local firms deploying the H20. On Sunday, a social media account affiliated with state-run China Central Television slammed the chip's supposed security flaws and inefficiency. Let's get perspective from Wang, founder at Constellation Research. I mean, it's quid pro quo, very unusual. What's your first take on what you're seeing right now?
I think in the back of our minds, we're trying to wonder if this is a national security issue or if this is going to be really just a tax-based kind of trying to get U.S. manufacturing back into the U.S. kind of issue. And I think it's very confusing at the moment because we don't know if this is about national security anymore or if it's really about moving manufacturing to the U.S. and changing supply chains.
Is this worrying? Because it does set a precedent as well. First, Nvidia and AMD. Who's next?
Yeah, and it's a great question. Is it going to be TSMC coming through the U.S.? Is it any kind of Intel chips that are coming back? I think it's got to have a framework, and I think the policy needs a little bit more work to say certain chips and certain categories that might be a national security issue, that might create a Section 232 issue. Those are the chips that we're going to have to figure out that are national security, CFIUS review. I think this is a little bit more arbitrary, but I'd love to see what the details are. But there's been this push to get H2O chips into China by both by Nvidia and the MI chips as well by AMD, and it's a big piece of the revenue. So the question is Nvidia and AMD one generation, two generation, or three generations ahead of where the Chinese are? Do they believe that we're going to be the American chip manufacturers are going to be ahead of the Chinese chip manufacturers for quite some time, or will we have a national security issue for this short-term gain? So I think those are the questions that are out there to be assessed.
Let's pick up on the issue of national security. We know that H20 chips are not the top-of-the-line chips, and they're produced for China. The thing is, there are some U.S. military experts saying that, you know what, those H20 chips will be beneficial for Chinese military. There are still concerns out there. So how are we squaring that? How are we making sense of what's happening?
Well, what's interesting about this is that inside China, they're afraid that there are back switches or back doors that are going on in these chips. And they're wondering if there are kill switches that AMD and Nvidia have put in these chips. So they're creating some FUD about this internally in China because they don't want their military to use these chips. And then on the other hand, we're also actually creating some FUD as well in terms of we don't want them to use it on the national security side. So I am curious to see where this plays out. But it sounds like, the influence that Jensen has had and Lisa has had in the White House may have given way to saying, hey, we'd rather them use our chips in the long run, use the CUDA software, use other places to get and adopt American technology. And there's probably a belief that they're 2 or 3 generations ahead. So that may have been the calculus behind this. What I am worried about, though, is what if they're wrong? What if Huawei and other chip manufacturers are able to catch up more quickly? That's going to create a national security issue for the West. So this is an interesting kind of play of words from both China, harping on the HTO chips, harping on backdoors from U.S. manufacturers, and at the same time, U.S. chip manufacturers trying to get business into China again.
Ray, how are you assessing the H20 chips? I mean, are there reasons to be concerned for both sides, both China as well as the U.S.?
Well, the difference between a Blackwell chip and a Rubin chip with an HTO chip is still a couple generations ahead. But the technology using to layer those chips and to pack those chips in, that's really what China is trying to reverse engineer and understand how to do. And at the same time, when you think about the global war for AI, what's going on is China has data. It has low-cost energy, but it doesn't have the chips yet. The U.S. has the chips. It has the data, but it doesn't have low-cost energy. And that's really the battle here. And what we're seeing is that these AI startups are scaling at a rate we've never seen before. We're seeing 100-person companies take on the big software companies. We're thinking 1,000-person companies in services that are able to get to $1 billion. Just the other day, we bumped into a company that had 4 people doing $40 million in revenue. These are the AI exponentials. And if we're worried about powering competition from the U.S. side with China, these chips are going to allow these companies to be able to get to that kind of exponential scale. So that's the national security concern.
Ray, there are reports out there saying that, you know what, it's not really H20 that China is concerned about. It's actually the MI303. Can you put perspective on that?
Yeah, so that's the interesting thing. There's a belief that there's backdoors in a lot of the U.S. chips, kind of like there was a concern about Cisco routers and Huawei routers sending information back to their respective countries. I think on the AMD chips, that's actually a really bizarre concern because they've been able to test it. We've been able to test it. You can see that those aren't those chips that are out there. There are no backdoors on those U.S. chips. So if there is a concern, there would be a concern more on some of the products that have Chinese components in U.S. products. I think there's been a lot of cases where we've seen chips are sending information back. You have cases where there are American routers sending information back to Chinese stations with malware inside that have been very hard to detect. So it's a question of who's done a better job in terms of convincing the other side that their security apparatus is doing better or their spying operations are doing a better job.
We know that you track Nvidia really closely. How important is the China market for Nvidia? Right now, its revenue from China is not that meaningful yet, correct? But that may change in the years ahead.
Well, it's a question of can you get Chinese companies to adopt Nvidia chips at scale? The short answer is we're seeing routes to market via Dubai, via Singapore, and even in the US where people are smuggling chips into China because they want the Nvidia chips. The lock-in layer is really CUDA, which is the software layer. If you can get Chinese companies to build on top of the CUDA layer, then we actually have a standard that Nvidia can actually bring Chinese customers on board and continue to bring them on board to have that kind of lock-in effect that you have with other customers. But the challenge is the Chinese have been very innovative and they've been very good at reverse engineering a lot of our technologies on the West, and you can see them actually advance in some areas. And so this is, an interesting calculus. I think it's a calculus that either Jensen has made, Lisa Su has made, in the sense that they believe that they have enough of an advantage that it doesn't pose a national security risk, and they may have convinced the U.S. security apparatus that this is not as big of an issue, and we will pay the price. We will pay the 15% tax to get there.
So it is a game changer for both companies with this arrangement. We know that when AMD releases earnings recently, Lisa didn't include the revenue from China because she says there is a lack of clarity. With the current arrangement, there is more clarity and investors should be cheering this?
I think in the long run, investors will cheer if this continues to be a thing where older American chips are able to get into China. There's a business that's built against that. We're talking anywhere from $3 to $5 billion between these two companies that could be grown in China between now and the end of the year. There is a huge demand for those U.S. chips. The question is, will the Chinese government want that huge demand? And so we'll see how they react in terms of their policies, kind of how they were treating Apple and the iPhone and the way they treated Tesla with their vehicles, being more nationalistic. But at the end of the day, the U.S. chips are better.
We know that there is intensifying competition between the two sides in the area of chips. We also are getting some reports that perhaps China is repurposing gaming chips. Can there be any truth in that?
There's a lot of things you can do when you're kind of in an export ban. You get very innovative. We saw that with what happened with DeepSeek and their ability to use smaller language models to achieve very interesting outcomes on AI. Everyone is now copying that open source model. The necessity is the mother of innovation, and that's really what's going on in China. But there are other chips out there besides GPUs. China could eventually build a tensor processing unit, kind of the way that Google has. There's all advantages that are going to be happening on the quantum computing side. Quantum and AI is going to converge. So the gaming chips are just the first part of it for getting the graphical process units in, but there's other things that are evolving in terms of where AI is headed, in terms of energy efficiency, in terms of advancements, in terms of how computation is done, and of course, in terms of how the chips are being stacked to get to 2 nanometer and even beyond.
Ray, given the concessions that we're seeing right now, how might it play out in the chip sector between the U.S. and China?
I think at some point we may get to a détente, and we don't know when, but I hope that we get to a détente where rare earths and chips and energy, additional exports, IP controls and rules have some kind of meaning. The reason we're here is because for decades we've seen China abuse the World Trade Organization, abuse some of those trading practices between IP rights and doing business in China. And I think really what's been happening is there's a worldwide backlash as to please protect our IP rights and let's have a fair trading system. I don't know if this is the way to get to it, but tariffs have started that conversation. You've seen U.S. versus China alignment happen. We've seen the Middle East move towards the U.S. in terms of investment, in terms of technology adoption, and in terms of standards. Every delegation is trying to pick sides at this moment, and the tariff discussions are more than just about tariffs. It's also about national security. It's about picking sides. It's about where you're going to adopt your technology stacks and which country is going to dominate those technology stacks. It's going to be important to get to some level of détente if we're going to ensure better world prosperity, better trade over time, because the world doesn't really need a battle between U.S. and China. So
how best to invest? Which are the must-buys? Have you made any changes to your holdings recently?
No changes. I think what's really important is 6 of the Mag 7 are paying for the 7th Mag 7, which is Nvidia. AI is going to be a huge boom. We believe that artificial intelligence, AI intelligence is doubling every 7 months. And so the capacity from an energy perspective and the capacity from a chip perspective and what you need from the software layer is growing at a massive rate. The only difference I would say is invest in more energy stocks where you can get small modular reactors, where you can get access to cheaper utilities. I think that's going to be an area where it's going to continue to grow. And of course, we're going to see a lot of advancements in smaller companies that are taking out larger companies in what we call AI exponentials. It's a piece of research we put out last week.
Ray, thank you so much for that. Ray Wang, founder at Constellation Research. We've had headlines in the last couple of minutes. Australia saying that it will recognize the Palestinian state in September. Albanese speaking in Canberra. Of course, we've heard from the likes of France as well as the UK saying that they will make that recognition as well in September, along with the likes of Canada and Singapore. Singapore saying that it will recognize the Palestinian state if it puts a government in place that is effective and one that renounces terrorism. Again, Australia saying that it will recognize the Palestinian state in September. Up next on Insight, we get the market outlook with Bank of Singapore, who'll tell us why their base case is for U.S. stagflation to continue weakening the dollar. CIO Chia will be joining us in just a moment. This is Bloomberg. President Trump's tariff impasse with New Delhi is hitting India's stock market hard. It is especially in comparison with Chinese stocks as Beijing continued trade talks under a truce with the U.S. over the past few months. The MSCI India Index now on pace for its biggest annual underperformance against its Chinese peers since 2017. And India's overall equity market cap is now trailing onshore China's by $6 trillion. Let's get market insights from Chia, Global CIO at Bank of Singapore. More and more, China's looking pretty attractive.
Yes, indeed, Haslinda. I think the divergence is beginning to show up in the markets. Yeah.
How do you think those trade negotiations will perhaps lift Chinese stocks going forward, and which sectors in particular, are set to benefit?
Yeah, I think what investors had expected earlier on since Liberation Day was that China would be, the major candidate in terms of the tariff uncertainties, but it turns out that actually has been spread out pretty globally, and as you mentioned, India being one of those who have now been threatened with an additional 25% tariff, bringing it to a total combined of 50%. China, in contrast, I think we have seen a little bit more reprieve and carve-outs, etc. So that has been actually a relief for markets. That's not to say that we're out of the woods. Clearly, there's still some time to the implementation. And in terms of Chinese response, we do see an underlying confidence in terms of diversification of trade flows into other regions. For example, year-to-date trade flows to Europe, ASEAN, and other intra-Asia trade has picked up at the expense of exports to the U.S. So there certainly seems to be a bit of substitution happening there.
How best to play China? Just today, we heard news about how Nvidia and AMD will give 15% of their revenue from the sales of their chips to China. That is quite a reversal, a huge reversal in decision.
Yeah, a rather unusual development. Of course, it's yet to be confirmed. But certainly, I think where we see as investors is what is relevant domestically and then what's relevant in terms of a global trade flows. So domestically, I think the key development we've seen is the 反内卷 or anti-involution policy, which has been seen by investors as a plus in terms of reducing oversupply. So some version of supply-side reform, which would be beneficial for some industries, putting some sense into the competition as well as production, and also even for the platform companies. So we see that as a positive, but that's not enough for China in terms of the eventual outcome. We're still very much looking forward to demand-side reform if consumption can pick up, and clearly that's part of the equation in terms of economic reform, and that certainly would be a potential catalyst for the Chinese market.
If we see those catalysts, and considering that China accounts for a huge part in the basket, would that perhaps, help you reassess how attractive EMs, or especially those in Asia, are in the next 12, 24 months?
Yeah, so in our tactical asset allocation, we've actually been positive on Asia ex-Japan since last year, with a focus on certain markets, Hong Kong, China being one of them and Singapore being the other. As far as Hong Kong, China is concerned, there was, first of all, the valuation support. But what we're seeing now is also a re-rating of the market, and that has been very helpful for valuations and, of course, share prices. I think going into the next phase of development, we really want to see see also new industries being the engine of growth. China being in the traditionally very real estate focus, and certainly the Chinese government has poured a lot of effort into doing that. So as far as what we mentioned, right, AI developments, I think we cannot generalize that the future of AI is only going into the US sectors which have been priced in, but certainly there will be emerging technologies, emerging players in China that we're keeping an eye on, some of whom may not be in the public space. So certainly private equity as well is one of the areas that would be interesting for investors looking for twists in terms of AI adoption as well as AI developments.
It does seem like the appetite for Asia also depends on US and the US dollar. So now saying perhaps, we may see stagflation. How might that play out into appetite for Asia? Others say, instead of two, rate cuts by the Fed, we may not see because inflation is likely to stay high for longer.
Yeah, so I think for the U.S. economy, we see rising risks of stagflation. We peg it somewhere around 60% probability. And there, of course, the Fed will be between a rock and a hard place in terms of, first of all, its first mandate of price stability, and the other, of course, job stability. So that's going to be a big dilemma. And as a result, the dollar has been probably the victim of this policy uncertainty. And we've seen the weakening dollar, albeit with a bit of a bounce in recent weeks. But still, year-to-date, DXY is now about 9.5%, which really erodes return, even if the underlying assets have performed. So that goes back to our thesis now on Asia ex-Japan as well as Europe, two markets that we are overweight in from the context of diversification. Not to say that the U.S. will not remain a core part of portfolios, but certainly at the margin for clients and as well as investors who are very much exposed to the U.S. on a portfolio basis, it makes sense to diversify, not just geographically, but from a currency perspective into non-dollar assets. And that's a trend we've been seeing all the way from institutional investors to retail and to wealth and family offices. So I think that's resonated a lot with investing in Asia as a base case. Yeah.
What is the biggest risk to your assumptions? Could it be oil prices?
Yeah, I think ultimately the effect of tariffs on the global economy is not yet apparent. And it will be idiosyncratic, right? Because of, first of all, the menu of tariffs on global flows is, the impact on global flows is still not totally anticipated. There will be winners and losers. So certain companies will probably suffer more and be acquisition targets, or maybe even suffer, more existential risks in terms of their business models. Others will benefit, right? So I think we continue to focus on companies that have resilience in terms of their ability to absorb this shock, if you like, on the demand side. And that is ultimately the active investor's role to spot these opportunities.
Are you no longer keeping a close eye on oil? Is that a factor that you might consider? We know that oil keeps trending lower even today on the back of expectations of that meeting between Putin as well as Trump on Friday.
Yeah, so the dynamics of oil right now is geopolitical, but also, on the other hand, demand-driven. So if we should see recessionary or stagflationary risks, oil does have downward pressure. And, of course, that can be controlled on the supply side. I think the commodity we've been focusing a lot on is gold. And, in the midst of the uncertainty, and including geopolitical and military risks around the world, gold has not just held steady, but, we see increasing allocation towards gold for all the reasons we know about fiscal stress on not just the U.S., but many economies going forward. So we do see allocation to gold as more a strategic move. Oil, on the other hand, we would be watchful of the cyclical impact on the oil price. Yeah.
And quickly, Jean, your strategy for the fixed income market?
So in fixed income, we're relatively cautious on longer dated paper. So we are neutral on duration right now. And in terms of the developed market, we actually favor investment grade over high yield. In emerging markets, we favor corporates over sovereigns. And so that's really a very neutral stance on fixed income right now. We think that fixed income investing in the coming 5 to 10 years is very much about managing two things, right? Duration risk on the one hand, and of course credit risk. So very much selective. There's no one answer for the fixed income portfolio.
All right, Jean, great to have you with us.
Thank
Jean
you.
Chia, Global CIO at Bank of Singapore. Still to come, while India sweats on a trade agreement with the U.S., Pakistan has sealed its own deal for a 19% tariff rate that it calls balanced and forward-looking. We'll discuss that next when Pakistan's State Minister for Finance joins us. This is Bloomberg. Welcome back. You're watching Insight. Here are some more top stories we're following. Treasury Secretary Scott Bessent has told Nikkei News the U.S. aims to finish trade negotiations with remaining partners by October. Canada, Mexico and Switzerland are still seeking better terms after Trump's new tariffs took effect. Bessent also reaffirmed the importance of Federal Reserve's independence, but told Nikkei the next Fed chief should be forward-thinking. The WTO is predicting subdued global merchandise trade this year and next, saying activity remains clouded by President Trump's tariffs. But it lifted its estimate for trade growth this year to 0.9%, compared with an April forecast for a 0.2% decline. That's due to U.S. importers rushing to stockpile products, parts and raw materials before Trump's higher levies hit. Nobel Laureate Paul Krugman says President Trump's trade policy is too complex for the current bureaucracy in Washington. Speaking to Bloomberg, Krugman also called recent U.S. employment data concerning.
Yeah, what we've been seeing for a while is that the soft data, surveys, and just kind of tone and feel, has been weaker than the official numbers. And if we just before we got the ISM survey of services, which suggests basically an economy that's stalling, does not look at all good. And the official numbers have been showing a lot more strength than the soft data have. And what we saw on Friday was the hard data starting to converge on the soft data. So this really does look, Goldman's calling it an economy at stall speed. It is quite concerning.
It is quite concerning, and it puts that much more onus on every data point that comes after that. And eventually, it'll start to raise questions about the data that we do get, depending on who leads the BLS's economic statistics. Professor Krugman, I also want to get a sense from you, this unrelenting rise in the stock market that we're getting, even with all these concerns about the economy and the economic data that is being reported. Tariffs took effect this week, and the reaction from the market, if you look at the S&P 500's performance this week, is kind of a collective shrug. We're set to close out the best week since June. From where you sit, how healthy is the economy? Is corporate America's finances? Is it healthy enough to justify the S&P 500's 28% rally and the Nasdaq's 38% rally since April 8th?
Well, I would say, it doesn't look like it to me, but I am not. I have had, personally, zero success in predicting stock market movements, which makes me exactly like everybody else. Nobody is any good at this. And the stock market, what we do know for sure is that the stock market is of zero use as a predictor of the economy. Historically, the stock market has given you no indication of what's going to happen. You look and ask, did the stock market, there were a lot of warning signs before the 2008 financial crisis. The stock market didn't actually go down until Lehman failed. Yeah. So I don't think we should make too much of it at all, except to say that, it's Paul Samuelson's old joke that the stock market has predicted 9 of the last 5 recessions. So if you ask me what's happening, I can tell you stories, but the truth is I don't think the stock market is telling us very much at all about the economy.
That was Paul Krugman, Nobel Laureate and Distinguished Professor at the City University of New York. Taking a look where we are at Indian rupee and bonds, which have just begun trading in India. The Indian rupee, of course, has been trading close to record lows. Foreign investors have made an exit from Indian stocks on concerns about easing growth as well as those tariffs as well. In terms of the Indian rupee, 87.55 is the level we're looking at right now. It is up by about 1/10 of 1% versus the USD. And Indian bonds have been down down for 5 straight weeks, the longest losing streak in 2 years amid escalating trade tensions, of course, with the U.S. mired in a 5-week losing streak there. Let's get perspective from Lakshmi Iyer, Group President of Investments at Bajaj Finserv. Lakshmi, good to have you with us. First off, your take on how Trump tariffs will play out in India.
Yeah, hi, good morning, Haslinda. So firstly, yes, there is a lot of near-term uncertainty, stroke volatility from a market standpoint, given what we are seeing on the tariff front. But I'd say that being the part of it and the fact that we cannot deny that some sectors would get impacted, I think it's time for market participants to be slightly more inward-looking and embracing the fact that this volatility is here to stay. We'd also hasten to add saying that we are probably nearing the multiple, discounting of potentially bad news into the market at a much faster pace, which is what we have seen ever since, I would say, last month.
We know that India is still negotiating with the U.S. Do you think it is possible India will get a lower rate, and whether markets should play to that?
So as I mentioned, bulk of the negative news is on an incremental basis is almost kind of getting priced into at the current levels. And we've seen that from the peak price points markets have corrected in the month of July. And even month to date, the markets continue to be on a corrective spree. So incrementally, whatever happens, our view is that it may not be significantly adding to the delta of negative news, which makes it possible to, try and gather whatever you can on an incremental basis whenever there is a price point correction in the markets.
So stock picking is the way to go. What are you looking at? What are the considerations?
Absolutely bang on. It is a stock picker's market, no two ways about it. Scanning through the global macro, chiseling it down to the Indian macro. Of course, within the sectors, you have to be very bottom-up stock picking. We do like the overall BFSI space, even at the current juncture. We like inward consumer-oriented themes where there is likely to be additional wallet spends, and within that, I think the endeavor is to look for businesses within that segment which will continue to do the growth story despite the near-term headwinds that the economy is facing, largely due to global actions.
Lakshmi, what's your take on the Indian rupee? It's been hovering at record lows, and some expect that weakness to persist.
So the rupee has been weakening for all the right reasons, as we have already seen what's happening in the global markets. We have seen some bit of central banker trying to come in, but that's again very sporadic. On a trend basis, if you look at the dollar index, it's hovering below the 100 mark for a fairly long period of time. So our sense is that around these levels, closer to the 88 level on the dollar rupee is where one could see some stability. But given that fiscally we are in a way better situation, our macro numbers, whether it is the headline CPI or the core numbers, each of these continue to bolster, I would say, the other headwinds that we are facing. I'd say that closer to 88 is where markets could find some consideration, but a natural depreciation in the current market scenario is something which the market has actually taken it in their stride.
Isn't it a fact that this is an RBI that is willing to intervene if there is a need to?
See, the central banker has always maintained its stance, whether it's on the liquidity front or the currency front, that there has to be an orderly movement. And as long as that orderly movement continues to exist in the market, I think it should be okay. Foreign investors have been net sellers of Indian equities. So intuitively, that could probably weigh on the currency in the near term. But, every market action probably may not necessarily need into a central banker intervention.
In terms of the RBI movements in the coming months, what are you anticipating, especially on the back of a Fed that's been priced to do 2 cuts in 2025?
So, clearly, Haslinda, in India, we've hit a century as far as rate cuts go. We've seen a front-loaded 100 basis points of rate cut. Are we at the end of the rate cut cycle? Maybe yes. Does that mean that there would not be any more rate cuts in India? Probably no. So I think it's prudent to now wait and watch for some bit of the transmission to actually percolate into the real economy, which we've already started seeing incipient signs of. And secondly, also wait and watch how the Fed reacts. The Fed fund futures are pricing in a 90% plus probability of a rate cut next month. So I think we'll draw cues from that. And as I mentioned, the macros definitely are pro the easing cycle. We are certainly at the fag end, but there is still some more steam left. Probably before we end this financial year, there could be probably one more rate cut on the anvil.
And how might this play out for Indian bond yields? We know that Indian bonds have been declining 5 weeks in a row, the longest losing streak in about 2 years.
So the bond markets were clearly disappointed after the RBI decision because some sections did expect a rate cut at about 6.4%, max maybe a few basis points of uptick further. I think they would pose a good entry point at the current levels, given that we are not really staring at a reversal of rate action at the current juncture, and liquidity continues to be fairly robust even as we speak right now, north of 3.5 lakh crores or 3.5 trillion rupees.
And in terms of demand, does it feel like demand is drying up?
Not really. I think there is reasonable good amount of demand, especially for bonds at the longer end. And typically, we've seen when, the 30-year and 40-year bonds breach the 7% mark, we get the long-only terminal benefit funds, insurance funds, pension funds, etc., coming actually to buy onto these bonds. While the premiums, as we see, the 5x30, as we call, the gaps are pretty huge. Well, that actually poses a buying opportunity. So I don't think supply is or supply-demand mismatch or lack of demand is clearly a worry for the bond markets. But as I said, near term, the rupee sentiments and the no rate cut sentiment is slightly more overpowering at the juncture.
Lakshmi, as always, great insights. Lakshmi Iyer, Group President of Investments at Bajaj Finserv. Coming up, Pakistan's State Minister for Finance, Bilal Azhar Kayani, will be joining us exclusively as we take a closer look at that trade deal with the U.S. Keep it here with us. This is Bloomberg. Welcome back to Insight. Pakistan's Army Chief Asim Munir is on his second visit to the U.S. in less than 2 months. In the latest sign of warming relations with Washington, Munir held talks with U.S. military officials this time after meeting with President Trump in June for a private lunch. Pakistan's closer ties with the U.S., including a 19% tariff deal, are coming at the expense of India, Prime Minister Narendra Modi has so far been unable to get a deal done with Trump, who's threatened to double India's tariffs to 50% later this month of its Russian oil purchases. New Delhi also bristling at Trump's repeated claims he brokered an end to this year's 4-day conflict with Pakistan. Trump's apparent warming toward Pakistan has raised questions over the U.S. position in one of the world's most strategically important regions. Joining us exclusively to discuss this and more is Bilal Azhar Kayani, Pakistan's Minister of State for Finance. Minister, good to have you with us. First off, 19% better than the 29 imposed on India, possibly with an additional 25 for India. What's your take on that level of tariff?
Good morning, Haslinda. Thank you for having me on your show. Definitely, this trade deal is a landmark deal for us. We've secured a tariff that is 10% lower than the tariff we had. And as you stated, and as you were showing on your screen, it's the lowest tariff in the South Asian region compared to our major export competitors. So definitely this is a significant development for us, especially given that the U.S. is our largest single export destination, accounting for $6 billion out of the $32 billion that we exported in the last fiscal year or financial year, which just concluded in June.
Minister, give us some details. I mean, what is Pakistan giving access to in terms of U.S. products?
So we've got a broad understanding in terms of this headline tariff that I've just mentioned to you, and the agreement with more details will be negotiated and discussed in the months ahead. Which would include various aspects, whether it's rules of origin or market access or tariffs for specific lines reciprocally. But at the moment, we have a broad understanding, and the details are to be thrashed out in the months ahead.
What are you hoping to get out of the discussions you're having right now?
Well, we already have one outcome. As we've just discussed, which is a better headline tariff, not just relative to our own tariff for the U.S., but also relative to the region. But hopefully we will also be hoping to get a better tariff on certain major exports, better than the headline tariff. That's obviously going to be one objective. The second is, materializing a commitment by the U.S. To invest more in Pakistan in certain sectors, and that has also been discussed as part of these discussions, and we are grateful to the U.S. for making that commitment, and specific sectors have been identified for it, including the energy sector, mines and minerals, IT. So we are hoping to carry those discussions forward. That intent has been shown, and both sides intend to work together to make sure that we can explore the possibilities to make those investments to make that FDI happen.
As part of the tariff deal, many countries have committed to buying more from the U.S. For Pakistan, what is it buying more of?
As I said, we'll be finalizing things, finalizing more details in the months ahead. But, the U.S. does have a trade deficit with Pakistan, and obviously they'll be hoping to increase their exports to Pakistan. That will be a part of the discussion in the months ahead. And they will obviously be looking for better tariffs for their products as well. Just like, as I mentioned, we've already secured a better headline tariff and are hoping to secure better tariffs for export products. One thing I would like to mention to contextualize this is that Pakistan is also in year one of a major tariff reform internally. We've just announced a 5-year national tariff policy. We've had high tariffs traditionally, but this year, Prime Minister Shehbaz Sharif has announced in the budget that was passed just in June, a couple of months ago, or less than a couple of months ago, we've announced major tariff reforms where we will be eliminating 2 of our tariffs. So completely over the course of the next 5 years, we have 3 types of tariffs here: customs duty, additional customs duties, and regulatory duties. So the objective is to completely eliminate additional customs duties in 4 years, to completely eliminate regulatory duties in 5 years, and to reduce customs duties to a maximum slab of 15%, and to simplify it to just 4 slabs. And we've already taken steps to to that end in this year's budget as step one of those 5 steps. So overall, as well, Pakistan is intending to reduce its tariff barriers and has already taken major steps in the current budget.
I just want to be sure that you're unable to share with us at this point in time the kind of products, that you're buying more of from the U.S. In terms of non-tariff measures, Minister, could you share with us what are some of these measures as part of the trade deal?
So as I mentioned, naturally, the reduction of non-tariff barriers is a part of the discussion. Similarly, rules of origin. But as I mentioned, at this stage, all I have to share is what I mentioned to you. And it would be premature to say anything more at this stage because the negotiations to finalize the agreement are still to be carried out. And that will be happening in the coming months. Obviously, at the risk of repetition, as I mentioned, there is a commitment from the U.S. to increase investments in Pakistan, which we appreciate, and both sides intend to work on that as well in parallel.
Both sides have agreed to work on oil reserves. What does that entail? Can you shed some details on that, perhaps?
So as I mentioned, because there is a commitment, a statement of commitment by the U.S. to increase investments in Pakistan, one of the sectors that has been identified is the energy sector, which obviously includes oil and gas. And in the past, the U.S. has carried out studies both through U.S. aid and also the EIA, which, regarding the reserves in Pakistan. So I'm certain that those studies and other feasibility studies or geological surveys that have been carried out at our end will form the basis for discussions in the coming months between the U.S. Energy Department and our Ministry of Petroleum to explore possibilities for oil and gas exploration. And that will obviously be one of the aspects of the increased investment that the U.S. intends to or has committed to making here. I mean, we'll have to take that step by step, looking at the possibilities, finalizing agreements, carrying out the necessary due diligence, the feasibilities, etc. But both sides will work together, hopefully, and you'll see progress on that in the coming months to make those investment commitments materialize.
On a macro level, Minister, share with us the government's plans for Pakistan for the next few years to boost its growth.
Sure, thank you. We are currently, over the past year or so, we've been undergoing a macroeconomic stability journey. We are currently in an IMF program, an extended fund facility program, which is a $7 billion program, a 37-month program. And we've just we concluded our first review arrived at a staff level agreement in March, and we attained board approval by the fund in May for that. So that program was agreed in September last year. And we just concluded our first fiscal year at the end of June. We achieved a primary surplus, which for the second consecutive year, which was the bottom line or the single most important number one can say from a IMF program perspective. But in addition to that, we reduced inflation from around 23% to 4.5%. And we increased our tax to GDP ratio from 8.8% to 10.2%. We've increased our reserves, which are currently at around $14.2 billion. So we've made a lot of progress over the past fiscal year to stabilize the economy. We've also seen an improvement of ratings, both by Standard & Poor's and Fitch, and an improved outlook by Moody's. So we've made a lot of macroeconomic progress. The objective from here on in, Haslinda, is that we shore up those macroeconomic stability gains, but also move towards sustainable and inclusive economic growth. And the tariff reforms I just mentioned are a part of that. We are undergoing, we are in the middle of a major privatization effort, energy sector reforms, and the idea is to ensure that we can have export-led growth. So
Minister?
Yes, Haslinda?
You talk about stability in the economy, but your currency is seeing a lot of volatility. What's the plan to stabilize the currency?
So, Haslinda, the currency is actually, we've got a market-based exchange rate, which is part of the commitment with the IMF as part of the program. And the currency has been stable largely around the 275 to 280 level. Recently, there has been a slight increase, but largely, and it has come down again in the last day or so. But largely, it has been stable around the level that.
So market forces will dictate the level of the currency. Thank you so much for that, Bilal. Azhar, Kayani, Minister of State for Finance of Pakistan. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.